and gentlemen. Thank you for joining us tonight at Corporate Connect webinar, jointly organized by SIAS and supported by SGX. Today we have with us Mr. Geoff Howie, Market Strategist of SGX, to share with us on market updates, followed by Centurion Corporation presentation and Q&A session. Without further ado, let's welcome our first speaker, Mr. Geoff Howie from SGX.
Thank you very much. I'm just kicking off my video and making sure I share the screen quickly. Very good evening to everybody. As you would know, I'm the SGX market strategist and intend to provide a very quick overview of over the next 15 minutes or so on the current market drivers in the Singapore stock market, I guess with the added perspectives of the companies and the trusts that are listed on the exchange. Must point out that this presentation is designed to be purely informative, and the recent observations are predominantly on the stock market and in no way providing investment advice. So I've got the key chart here, which I've just updated, and we usually share at these presentations, but the STI's first test this year was clearly breaking above the psychological 3,000 level, which it first tested in mid-January before closing above on the 4th of March. Its next test was the 3,200 level, which was tested pretty much throughout April. And as can be seen by this chart, this 3,200 level has provided levels of support or resistance in one form or the other over the past 3 years. So market is still below that, but nonetheless, it has in the year to date generated, the STI has generated a 10% price gain, with dividends boosting the total return to around 12%. So the first quarter of this year was pretty much the STI's strongest quarter or strongest start to a calendar year since 2012. Across Asia Pacific, the STI has been the second best performer in the 2021 year to date, and only second to the very semiconductor-laden Taiwan Stock Exchange weighted index, which has generated a 14% gain total return. But from the current levels, near this 3140, the Straits Times Index would have to rally another 5% to reach the pre-COVID-19 high of 3280 back on the 17th of January last year. And to reach its May 2018 high of 3640, the STI would have to rally from here another 16%. Now, for the STI to return back to that 30th of October low last year, it would have to decline some 23%. Now, the key overarching driver of the STI and all global stock markets is, of course, the social and the economic impacts of COVID-19. As of the 23rd of May, we've had 1.7 billion COVID-19 vaccination doses administered across the globe, and the total recorded COVID-19 cases stand at just under 170 million. On Sunday, good news was that the new daily confirmed global COVID-19 cases had reached an 8-week low. And that had followed on from Thursday, which we saw a record of more than 33 million vaccine doses administered in one day. Hence, the more stable approach to the week of trading, I guess, we've seen over the last 2 sessions. Now, the green line on the chart's the Ftse ASEAN All Share Index, the regional index, and Singapore stocks make up around a quarter of the weight of that index. And I guess the recent moves in the global and the regional equities and the STI, they've really predominantly, the big moves have been driven by expansionary monetary policies, vaccine deployment, and of course, these expectations of sequential economic and earnings recoveries this year. The Fed Reserve balance sheet now has grown to near $8 trillion, and the European Central Bank balance sheet stands at around 7 trillion euros. So the policy stimulus has helped support businesses in all shapes and sizes, and by extension helped to fuel the moves in the stocks, global indices, commodity prices, and so forth. And that policy is expected to continue. Now in Asia, we're less money supply focused, but the sheer size of the money supply in the G3 has a really big impact on global markets. And I think it was a New York Fed governor last night, or a New York Fed report it was last night, that suggested the Fed balance sheet could reach as much as $9 trillion by the end of 2022. So in Singapore, our key policy measures, they really do remain the targeted fiscal measures. It was just on Friday, the Singapore government announced it was setting aside an additional 27 million to support private hire car and taxi drivers throughout to the end of June, amid the significant drop that we saw in ridership last week with the heightened measures. Now, Singapore's fiscal effectiveness, it was revisited in the IMF earlier in May. And the IMF noted last year that Singapore had what they said implemented a bold, comprehensive and coordinated policy response to cushion the impact of the pandemic. Now, the current policy mix was seen to be appropriate by the IMF, and they noted that should downside risks materialise, as a first line of defence, Singapore could further draw upon its fiscal buffers. And I guess as today's final GDP report noted for the first quarter of this year, the root of the contraction in Singapore's transportation and storage sector has been the impact of COVID-19 pandemic on the air, water and land transport segments. So if you look at the share price of ComfortDelGro, I think it closed today at $1.62. That's sort of similar to where it was at the end of last year at $1.67, where it ended 2020. SBS Transit closed at $2.99 today, and that's also kind of near where it ended 2020 at $3.05. But nonetheless, the SDI, as we said, it has been APAC's second strongest market in the year to date. And the key driver for the SDI's performance has been just the simple fact that banks make up the biggest sector of the SDI, and they were the strongest sector by far across the world in the first quarter of this year. That same sector, that same bank sector that makes up 40% of the SDI through DBS, OCBC and UOB has been really highly correlated to global banks. In fact, last year, the day-to-day price moves of the three banks, DBS, OCBC and UOB, were 95% correlated with global bank indices. Now, even this year, you look at the median gain of the top quartile of global banks by market value, and that median return or median total return so far this year is 21%. And that's coincided, of course, with a number of factors like resilient business investments, the fact that the US 2-year and 10-year note yield curve has steepened from 80 basis points at the end of 2020 to 150 basis points at the end of the first quarter, or 160 basis points at the end of the first quarter, but consolidated around there to be near 150 basis points now. And the trio of DBS, OCBC and UOB really have continued to move in tandem with their global peers. As I said, the global median for the top quartile of global banks is a 21% return so far this year. It's exactly the same, 20 to 21% for DBS, OCBC and UOB. The three banks have also been recipient to more than $2 billion of net institutional and net proprietary inflows over the year to date. And this really followed on from that trio also averaging 21% gains in the last quarter of last year, also on institutional inflows. The three banks, they've also consistently reported more than 5 billion Singapore dollars in combined combined quarterly net interest income. And for the past 3 years, I think it's been for the past 3 years and 1 quarter that they've consistently reported more than $5 billion in that combined quarterly net interest income. They are currently pursuing digitalization, they're broadening wealth management services, and they're continuing to focus on supply chains and growth markets, which have been an element of resilience in Asia Pacific over the last year or so, based on the rise of the Asian consumer, among other factors such as us having 2/3 of the world's industrial robots in our factories here and so forth. So that has been a very big growth segment that the banks here in the region are really focusing on too. And I should mention too, the trio, that they're trading at an average 15% premium to book value. And that's again, very similar to the 18% premium the top quartile of the global banks are trading at. But also not just the macro and the banks is interesting, but also on the microeconomic front. Multiple companies and trusts they're either reviewing their operations, they're pursuing restructures, they're making acquisitions, they're transforming product lines and services. And look, these moves to, I guess, bolster efficiency and create new shareholder value, it has been somewhat expected, given we do here in Singapore, we do rank highly. We're a top ranking company, it's not a top ranking company, we're a top ranking country in terms of global competitiveness and business efficiency. I think we were the top globally ranked back to back in 2020 and 2019 in the IMD World Competitiveness Ratings. And look, strong technology advancements in recent years, they've disrupted the traditional businesses of Singapore Press Holdings, Singapore Telecommunications, and of course the economic challenges with Singapore have also called for renewed transformations over the past 12 months. For instance, Singapore Airlines is seeking to lead the new world, and listed a number of ways it was both transforming and strengthening its foundations ahead of this normalized resumption in global air travel that is expected. But nonetheless, I should say it's also coming up to 1 year that Sembcorp Industries and Sembcorp Marine also had their strategic restructure as well. So that has been a really important element of our market. But overall, the Singapore stocks, they have seen net institutional and net proprietary inflows of around $950 million so far in the year to date, with retail outflows of around $920 million, and the market makers making up the balance. Now, just one more slide I'd like to share is this Ftse ST All Share Index, which is basically like an S&P 500 is to the Dow Jones, in that the Ftse ST All Share Index incorporates the 30 stocks of the STI, about 50 mid-cap stocks, and then another 20 or so small to mid-cap stocks as well. So it's comprised of over 100 stocks, and this index has kept pace with the United States and the Europe and the UK heavy Ftse All World Index. So it's kept pace with the big global benchmark throughout the year to date. So the three banks, they make up around 35% of the Ftse ST All Share Index, and the index also includes another 36 REITs or property trusts that represent the REIT sector. The 10 stocks of this index that have been recipient to the highest net institutional and net proprietary inflows so far this year, proportionate to their market capitalization, are the 10 stocks tabled in the right of the slide here. So together, these 10 stocks, they've averaged close to 50%, around a 45% total return in the 2021 year to the 21st of May. And the real big current global economic themes that are really prevalent in the market have really been interwoven with the performance and the participation of these stocks in the slide, such as we said, the resilient regional trade and the corporate restructures. Meanwhile, I guess the 5 stocks of the All Share Index that were recipient to the highest net institutional and net proprietary outflows rather than the inflows, which is tabled, proportionate to their market cap, were AEM Holdings, Yoma Strategic, Asian Pay Television Trust, Sheng Xiong Group, and Keppel DC REIT. And of course, 3 of those stocks were amongst the index's strongest performances last year. I think AEM Holdings, Keppel DC REIT, and Sheng Xiong Group last year averaged 47% total returns. Hence, it's been a measured move to see the rotation out of those stocks. But look, I guess the first key driver that's kind of illustrated somewhat through these strong institutional participations in these stocks so far this year is, of course, the global technology trends and the enriched supply chains across the region. So in the year to date, you've got the Philadelphia Stock Exchange Semiconductor Index generating double-digit gains, only 11%, but UMS Holdings and Franken Group have also generated respective gains in the 20% levels, between 20% and 30%. At the same time, excess semiconductor demand has really challenged supply chains. So I think UMS Holdings saw its net profit grow 44% year on year in the last quarter, but within the region, it saw its sales revenue here at home increase 51%. Malaysia sales revenue grew by 93%, and Taiwan sales revenue grew by 70%. So the group has also made an offer to acquire that associate Geoff Holdings as part of its very decisive steps to diversify its revenue streams. And when you look at Franken Group as well, it attributed its revenue growth in the first quarter of last year, of this year, I should say, to higher sales with semiconductor, medical, analytical, and automotive segments. And it has customers all around the world, and estimated back on the 12th of May that the semiconductor segment will still post revenue growth in this half of the year as compared to the second half of last year, on the back of the strong global demand for front end and back end semiconductor equipment. So supply chain design and management is a key part of Franken Group's, I guess, what they call their integrated customer solutions. And in the annual report last year, one of the Franken Group logistics managers actually noted in the annual report for last year that was released recently that his most memorable experience last year during the pandemic was freight costs moving or increasing by as much as 350%, showing just how quickly supply and demand can determine how rapidly a market can move. So the supply chains and I think the ongoing development and widening of supply chains in the region has been a key factor for a lot of the resilience of this sector so far in the year to date. And then, of course, you've also got this big second driver in the markets, which is container ship demand. Yangzijiang Shipbuilding, its earnings grew 90% year on year in the first quarter of this year. It maintained the highest level in its outstanding order book since 2009 at the end of last quarter. And the order book includes a very large portion of container ships, and they maintain higher margins than the dry bulk carrier ships. But more importantly, the global trade has been the upside of the K-shaped recovery we've seen in the world. At the end of the last quarter, at the end of March this year, the World Trade Organization estimated global merchandise trade volume would increase by 8% this year. And I guess just to relay that point, how more efficient the regional supply chains have been, Food Empire Holdings is included in these 10 stocks. One of the 10 stocks that of the Ftse ST All Share Index saw the highest net institutional net proprietary inflows proportionate to its market cap. And for its first quarter results, it saw higher sales from the group's Southeast Asia market, but which partially offset the lower contribution from the group's SIAS and Russia markets. So the drop was in those Russia markets was related to the COVID-19 disruptions and logical and supply chain delays at ports and the lack of basically shipping containers worldwide. So that's been a very key theme. Getting near the end of this presentation, probably got about 3 or 4 minutes left, but the third driver has been the significant operational reviews or restructures to increase shareholder value, as we mentioned. So one of the more recent stocks to propose a significant business restructure, SBH, it's also included in this table. The property revenue has seen year-on-year growth for 12 of the last 16 financial years for SBH, which compares to the media revenue, which has registered growth for only 6 of the last 16 financial years, and last registered year-on-year growth in the media segment of 2% back in was the 2012 financial year. And the media revenue has generally or gradually declined some 60% from the FY12 levels, but property revenue has grown by more than 70% since FY12, and purpose-built student accommodation is part of that. SBH currently has a price-to-book ratio of around 0.7, and when you look at in the actual world, you break all the world stocks up, and you look at the GICS way they categorize stocks. There are around only 120 globally listed real estate operating companies, not developers, but just the real estate operating companies with a market value of more than $1 billion US. They trade at a median PB ratio of 1.2. For those that you know, might have also noticed when you look at those with those other companies that are also looking at restructures, such as CapitaLand, you can see I think CapitaLand had mentioned that the current premium commanded by real estate operating companies was an objective of CapitaLand's proposed restructure. And while not in the table, but Singtel is also reviewing both its MOB and Trustway businesses to identify ways to increase the probability of success or more successful execution. And we'll see more of that with its FY results, I guess, which are, I think they're due on Thursday morning before the open. But look, multiple companies and trusts over the past 12 months, have either reviewed operations, pursued restructures, or made acquisitions or divestments, or transformed their product lines and services, as we mentioned. I guess the key final growth driver is, of course, recent earnings growth. iFast Corporation, it reported a 50% year-on-year increase in its first quarter net revenue. DBS Holdings, its net profit doubled from the previous quarter. It increased 72% from a year ago. Those two stocks are in this chart. And then look, from the business update that Ara Logos Logistics Trust released, their DPU was up 36%, but their revenue was also up 8%. The DPU was up because of the basing effect, but with the gross revenue gaining 8%, management noted that the stronger portfolio performance was due to the commencement of new leases at several properties, as well as higher revenue generated from Australia. And their I think portfolio occupancy rate is very high for this logistics REIT. And you'll see it's also, it's 99.1%. I think it's exactly the same for EC World REIT as well. Okay, so I guess just wrapping up, the degree to which the global growth can swing from a decline of 4% last year to gain 4 to 6% this year, it really depends on COVID-19 containment, the efficacy of the vaccine, and of course, those secondary lines of defense. Returns in our stock market have either been staunchly sector-driven, i.e. bank stocks, what's happening in bank stocks in the US or REIT stocks in the US really has had a determining factor on the performance of our bank stocks and so forth, because all these sectors, they face the same type of challenges with the COVID-19 lockdowns and so forth. But at the same time, there's also been the extraordinary monetary policy, which has supported many businesses, particularly those more industrial and less consumer-facing businesses. And that's for that reason, the industrial manufacturing side, as we've seen in these slides, has been a pretty important, strong part of our market. But let me just bring this back up from current slide. So I guess getting to the new normal sooner rather than later, it's going to very much take a whole world of approach. And I guess to steal Centurion Corporation's annual report title, which I thought was very colloquial, very well put for their annual report. The way forward, I guess, is very much, as they said, together in strength. So in terms of more insights into these various segments of our markets, whether it's those companies pursuing the restructures or the sectors that have performed really well, or the stocks that are more economically aligned with the regional growth and the resilient supply chains, we of course do publish reports on an almost daily basis, and you can subscribe to those obviously on Telegram or through the emails such as the SGX My Gateway report. So I really appreciate the 20 minutes or so that SIAS have given us again, and I'll cut out now and not take any more of your time. Thank you so much.
Thank you, Geoff, for sharing on the market updates. Next up, we're pleased to have with us today Mr. Kong Chi Min, CEO, and Mr. David Ftse, Head of Corporate Communications of Centurion Corporation, to share with us more on the company. Mr. Kong and Mr. Ftse, please.
Hi, good evening, everyone. Thank you, Christine, for the introduction. My name is Kong Chi Min. I'm the CEO of Centurion Corporation. Limited. I have my colleagues with me. That's David Ftse. He's actually head of comms. He will be giving you a presentation of the group. As you know that we are basically, our core business is actually workers and student accommodation. During these COVID times, we are also not, I would say, spared. Our operations are also disrupted due to COVID-19. And perhaps during this session, we would share a bit more in terms of how we have actually responded to COVID-19's disruptions, and also how we have actually fared thus far. And particularly for last year, I feel that the way that we have actually been progressing, even though because of this threat of COVID-19, the resilience of assets and also the way that we have actually managed the operations has allowed us to actually come out better than what we expect COVID-19 would have actually affected us. So I hope that this thing will be over, right? With vaccines and all that coming into play, and because of that, I mean, our business will actually be rebound back to pre-COVID levels, and also demonstrate to all the audience here that the year-on-year growth, as per what we have actually demonstrated pre-COVID, will continue to grow as far as the expansion of the company. So without further ado, I would hand over to my colleague, Ftse, who will actually give you a brief introduction of the group using the presentation. Ftse?
Yes. Hello, everyone. Thank you for joining us this evening. Let me quickly share my screen for the presentation. Great. I hope you can see the screen now. Okay. In today's presentation, we will essentially be sharing our business update, which was published 2 weeks ago on the 11th of May as a voluntary business update to the investment community. Today, I will quickly cover off the business overview, how we have done in the first quarter, then followed by a quick review of our markets, where we are and what we see in the market dynamics moving ahead, and then how, as a company, we intend to manage and continue to grow during this challenging time of the pandemic, COVID-19. But before I jump into the presentation, I want to quickly put into context this first quarter presentation. For those of you who have been following Centurion Corporation, you will know that for the full year 2020, we were actually able to report a fairly stable performance. We were not affected by COVID in the first half of the year, and only in the second half of the year did we begin to see impact from COVID on our occupancies and revenues. Primarily, the impact was in our student accommodation, and the worker accommodation segment of our business was able to cushion or even bolster the performance. For the full year 2020, we had actually reported a decline in revenue of 4% to 128.4 million. And there was a fair valuation reduction, which led to a fairly large net profit after tax decline. But if you look at the core business, excluding one-offs like fair valuation, we in fact grew in profit, net profit to equity holders from core business grew by 8% to 41.3 million. That was primarily due to worker accommodation occupancy being quite stable, as well as government support from around the world, as well as reduction in operating expenses and distribution costs through prudent management, as well as low interest rates that benefited as well. So with that backdrop, let me now go into our first quarter business update. In essence, first quarter 2021 compared to first quarter 2020 is really a post-COVID versus pre-COVID picture. First quarter 2020, we were not affected by the COVID pandemic at all. So really, the comparison is pre-COVID to post-COVID. Now, in first quarter 2021, revenue was 30.7 million, which is a fall of 13% versus 35.5 million in first quarter 2020. There was a dip in worker accommodation occupancy to 84% versus 89% last year. But the major impact, the larger impact, was in the student accommodation, primarily UK and Australia, especially Melbourne and Manchester, where the group's average financial occupancy for student accommodation was 56% this first quarter 2021 versus 85% in first quarter 2020. Nonetheless, the reduction in revenue was cushioned, in fact, quite largely by revenues from the worker accommodation assets. So as I was mentioning, the fall in revenue was mainly from a dip in Singapore worker accommodation assets, but mainly from UK student accommodation and student accommodation in Melbourne, Dwell Village, Melbourne City, where these occupancies were primarily affected by travel restrictions and COVID conditions. This impact was moderated by revenue contributions from worker accommodation assets, which we had added in second half 2020, as well as improved performance in Malaysia. So in 2020, we were able to continue to grow our asset portfolio, securing a master lease in Singapore for 4 quick build dormitories. 2 of these dormitories are now in operation since fourth quarter of 2020, and 2 more of these quick build dorms will become operational in the next quarters. Also last year, in the fourth quarter, we secured a master lease for a 6,000 bed worker accommodation in Selangor, Malaysia. This is quite strategic. Not only does it enlarge our portfolio and revenue stream from Malaysia, it now puts us with presence and footprint in both in the south, in Johor, the north in Penang, as well as the central region, Selangor of Peninsular Malaysia. Last year, as well as first quarter this year, we were able to see increased occupancy in our Malaysian PBWA portfolio for reasons which I will explain later in the market outlook for the country markets. As of 31st March 2021, we have 1.6 billion in total assets, with total borrowings of just under 0.8 billion. Net gearing ratio is 48%, down from last year, which was 51%. Our interest cover is very comfortable at a ratio of 4.3 times, and average debt maturity is 7 years. So we do not anticipate any challenges on the cash flow side. We have cash and undrawn committed facilities of 191 million. As at 31st December, we had cash balances and credit facilities of more than 80 million available. So ample liquidity to tide us through the uncertainties that still remain with COVID-19. So one of the strengths of Centurion that has helped us to remain fairly stable despite the pressures and challenges of COVID-19 is that we have a well-diversified business portfolio. So we have 2 core businesses. One is worker accommodation, which we are present in Singapore with 28,000 beds and 6,400 more beds from the QBDs, quick build dorms. In Malaysia, we have 36,744 beds with an additional 4,440 beds in the pipeline coming up this year, into operations this year. And then the second core business is student accommodation. We are present in the United Kingdom with 2,800 plus beds, in Australia with 896 beds. In the US, we manage 2,145 beds through a private fund. We manage the fund and we manage the properties, and we hold 28.7% of the units in that fund. So we derive operating income from the operations of those portfolio, as well as fee income from managing the fund and managing the properties in that portfolio. So in total, we have 1.9 billion assets under management, 73,368 operating beds in 35 operating properties in 17 cities in 6 countries. So that this diversity allows us a fairly good balance and stability, so that we are not over-reliant on a single market. We were able to prudently expand our portfolio capacity by some 8,300 beds, or 13% in the last year. This year, we have in the pipeline an additional growth of 8,150 plus beds, or 11% in capacity. This has been very important as it has been able to expand our revenue streams and cushion the impact pressures of occupancy in our student accommodation markets. So next, I will go on to review our business in each country briefly. In Singapore, which is our largest market, comprising more than 60% of our revenue source, worker accommodation is currently quite fluid. I will spend a few minutes to explain the demand-supply dynamics here. As many of you may know, there are over 300,000 work permit holders, migrant workers in construction, marine, shipping, and process sectors who by law, MOM requirement, must stay in approved dormitory accommodations. Now, additionally, there's another over 300,000 workers in other sectors like service, logistics, manufacturing, who, even though are not required by law to stay in approved dormitories, these are migrant workers who can stay in private residential apartments like HDB or condo apartments, but many employers still choose to put them in purpose-built worker accommodation. So we have the captive market demand of 300,000+ and an additional potential market of 300,000+. Against that, the supply, which is quite closely regulated by the Singapore government, the best class of worker accommodation is the purpose-built worker accommodation. And these falls into 2 brackets, totaling 200,000 beds. There's the long-term worker accommodation, which typically have leases of 20, 30 years or longer. All of Centurion's worker accommodation are in this segment of long-term purpose-built worker accommodation. In fact, one of our properties has a lease of over 50 years, and another property is a freehold property. And the other 2 are on 20 plus 30 years leases. The other type of purpose-built worker accommodation is the short-term leases, which typically are 3 years plus 3 years plus 3 years, and then the lease tends to be ended after that. So you will see there are 2 types of accommodation that are built. One is the reinforced concrete structures like our dormitories, and then the other type are the more temporary looking structures, which are the short-term PWAs. So this comprises the 200,000+ of the better accommodation, commanding better rentals and higher demand. Then to fill the demand, factories to be converted into dormitories. Up to 51% of the space in a factory can be converted into dormitory on application. Typically, these are short leases, 1 year plus 1 year plus 1 year, 3 years typically at the most. Then there are some on-site dormitories at construction sites, and then some shop house lots in various districts like Geylang, Little India are allowed to be rented out for these CMP workers. But in total, this supply During COVID, the government tried to de-densify the dormitory population by providing alternative interim accommodations. So this new supply during the COVID year is expected to add about 60,000 beds in short to medium term arrangements. Out of these, 25,000 are quick build dormitories. We have secured leases for 4 of these dormitories, accounting for 6,000 plus beds. So in essence, we are managing more than 25% of that supply. But also some of these quick build dorms have been repurposed for migrant worker onboarding centers rather than long-term accommodations. So not all of that supply is addressing the demand. There are also temporary living quarters and quarters that are allowed to be converted from offices or on-site. And these are very short-term. In fact, some of the temporary living quarters have already completed their lease and are not being renewed. So these temporary interim solutions have come and are going to be progressively phased out. In the longer term, the government has announced that they will create an additional 100,000 beds in purpose-built dormitories that are longer-term leases, and we will have the opportunity to tender for those as well. So in Singapore, what we do see is that as of now, our operations at our purpose-built dormitories and at the quick build dorms are not affected by this current recent outbreak. And to a large degree, that is because of the safe living measures and segregation measures we have put in place quite effectively to contain that. If you look at the recent announcements in the media, there was a cluster at one of our dormitories, Westlake Woodlands, where out of more than 3,300 residents, 7 were detected positive. And all of these 7, 5 are reinfections, and all of these 7 were from one apartment unit. None of the other residents, even on the same floor, in other blocks, in other apartment units, were affected by this outbreak. So I think that goes to show that our segregation and movement restriction measures to prevent intermixing and contain spread have proven effective. Out of the 4 QBDs, we have secured the master lease last year. 2 are in operation, Kranji Way and Tuas Avenue 2. We are quite happy to say that occupancy is ramping up very well. We are close to full occupancy on these 2. And 2 more of the QBDs will commence operations in the next quarters. These quick build dorms are piloting new specifications with a bit more space in the living quarters. And the government have taken specifications that are quite similar to our existing dorms, where every room has its own ensuite toilet, shower, and also for us, kitchen. So these better specifications are attracting also better rentals. Demand for worker accommodation continues to be resilient, even for the current moment. South Asian migrant workers are not able to come in. Employers do require more migrant workers, and there is pressure to bring in more migrant workers as quickly as possible. So apart from alternative source countries, employers are also looking at how they can expand their workforce as quickly as possible. So demand will be resilient and it will return. We are engaged with the government authorities on the future specifications, as well as what are the requirements for existing worker dormitories to be retrofitted, as well as government support for their transition. We are confident that in the long term, the purpose-built worker dormitories, which are the best in class for worker accommodation, will be the preferred long-term option for housing workers. Moving on to Malaysia, financial occupancies were not affected by the various rounds of MCOs across the different states. And currently, the latest MCO also is not affecting our financial occupancy. In fact, during lockdown time, employers are not able to move workers out, so financial occupancy remains stable, during lockdown MCO times. We expect demand for quality worker accommodation to grow in Malaysia because the government in Malaysia has made an amendment to the Housing Act for migrant workers, and employers are now required to provide better quality housing of certain standards for their migrant workers. Even though the government has extended the period of time for employers to comply until the end of this year, the demand is continuing to grow, and we expect demand as well as rentals to be stable, if not continue to grow quite well. We have continued to therefore expand our Westside Malaysia portfolio. As mentioned earlier, we added a property through master lease in Selangor last year, 6,044 beds. This year, we have begun, since last year, we have begun asset enhancement initiative at Westside Tampoy to add 3 additional blocks. We expect that to be completed by third quarter of this year, adding 3,600 beds. Additionally, we have acquired and are retrofitting 2 existing blocks, brownfield, with 840 beds, and this is adjacent to our Westside Pasir Gudang and should be coming operational in the next months. Westside Malaysia is well able to meet requirements under the new amendment of Housing Act, and we are currently in discussion with JTK SM, which is Malaysia's version of MOM, to be certified under the new requirements. So worker accommodation in Singapore and Malaysia, there are pressures, but we do see financial occupancy continuing to recover, and performance should be stable, and the demand is resilient. In the UK, the government has announced that university students should go back to campus since the 17th of May, and we are beginning to see students returning. Inquiry volume as well as booking volume has begun to recover, and we expect occupancy to recover gradually as the pandemic conditions stabilize. Enrollments based on UCAS application data for 2021 shows an 8.5% annual rise in university applications, and out of that, 17.1% is from foreign, non-EU countries. The domestic local student population is also growing as university-age students. That segment of the UK population is a growing segment in the UK population. So demand is certainly resilient and growing for the UK student accommodations, and we therefore expect occupancy to recover as the pandemic conditions stabilize. In the US, our occupancy and rental rates have been good and performing, improving, not affected by COVID, even through 2020 and into this year. As our assets, our 6 portfolio assets in the US cater mainly to domestic, interstate, and intrastate students. So less than 5%, in fact, closer to 2% of our residency is international, and that is mainly in one asset in Madison, Wisconsin, Towers on State. And there we are also beginning to see a recovery in inquiry and bookings from internationals as well. Australia perhaps has been the hardest hit among our country markets, where COVID-19 has disrupted demand for accommodation. And as the Australian government continues to hold very firm on travel restrictions and international arrivals, we are seeing recovery fairly slow. In Adelaide, we are still performing fairly well with above 50% in occupancy. And that's mainly because the internationals have remained in city instead of returning home. In Melbourne, that we are most affected. Nonetheless, we have been noting international enrollment numbers. While these have dipped year on year, the numbers are still strong, with 500,000 international enrollment numbers in February alone and 400,000 plus in the month of March. So we do see pent-up demand, and as and when travel restrictions are lifted, we expect these international students to once again be able to enter the cities and require student accommodation. Perhaps this will be slower than the UK, but as the travel restrictions are lifted, we expect recovery to return. In Singapore, we have a small student accommodation asset at Dwell Seligi. This is on a 3+3+2-year lease from the Singapore Land Authority. During the COVID year, SLA required the bed capacity of this property to be reduced from 332 to 240 beds. We have therefore assessed and decided we will not take the final 2-year lease extension, and therefore we will expire this property in June next month, when the second phase of the lease term expires. In South Korea, we have a small asset, 208 beds, which we own through a joint venture, 55%. With the travel restrictions lifted, we see students returning, and this property has seen recovering occupancy, growing above 50% now. And we are seeing mainly European students as well as some Asian students arriving in South Korea. So that sums up our market performance for first quarter, as well as some sense of the outlook for the coming parts of the year. Looking ahead, I think we have to recognize that occupancies have been impacted more in the student accommodation, less in the worker accommodation. In Malaysia and US, in fact, occupancy not impacted at all. We have seen some debt delinquencies, not so much delinquencies, but more delays, not so much bad debt. And we have made provision for that at the tail end of 2020. We do expect recoveries in occupancies as vaccine rollouts, but the extent and the speed, the pace of this recovery remains uncertain. Travel bans and movement restrictions continue to provide headwinds, but we do see that there is gradual resumption of work and university on-campus programs, and we will continue to practice very vigilant measures for safety in all our assets with its related operational cost increase. Despite the uncertainties, the group will continue to build on our portfolio, primarily through asset-light means during this time, not so much to acquire on our bottom line balance sheet, but more through master leases and JVs. We are in dialogues with authorities in Singapore on the future specifications and how this will affect us. We understand the government has made announcements that there will be time given and consideration for practicalities of existing dorms to be retrofitted, and that there will be some extent of government support for businesses and the worker accommodation industry in the transition. So we are certainly engaged in that discussion. In Malaysia, we are working with JTKSM, as I mentioned, to certify our assets, and we do not anticipate any impact from the new standards. In fact, we anticipate increased demand, pushing rentals as well. For the student accommodation, to address the current pressures, we are offering students flexible lease terms across our different country markets so that we can support the students' needs, as well as attract pre-bookings while they are uncertain. And in the UK and Australia, we continue to tap domestic demand, including offering shorter-term leases, and where possible, also attracting working professionals where relevant. We were able to cushion the performance of the business in 2020 through being very stringent and diligent in management and operational efficiencies, and that helped us to still come out of 2020 with a net profit after tax growth of 8%. We will continue to practice this management and operational efficiency this year, managing costs, conserving cash, and taking opportunities to enhance our portfolio with to expand our revenue generation streams where strategic and sensible. So in the face of COVID-19, we are confident that our portfolio of assets are well diversified in segments as well as markets. The market demand fundamentals are still firm, and the resilience of both our PBWA and PBSA segments are strong. And we are confident that as business and travel activities resume, and as vaccine rollouts grow gradually globally, occupancy of our assets will continue to improve. That brings me to the end of our briefing today. Open for
Mr. Kong and Mr. Ftse. In our last segment, we will have a Q&A session. You may post your questions in the comment section below and we will endeavor to answer them. Due to time constraints, we would like to seek your understanding that not all questions will be addressed. Without further ado, we would like to invite our moderator for the evening, Mr. Benjamin Goh, Head of Research, SIAS, as well as our two panelists who are already on screen, Mr. Kong Chi Min, CEO, Centurion Corporation, and Mr. David Ftse, Head of Corporate Communications, Centurion Corporation. Ben can take it away.
Thank you very much, Christine. So thank you, David, for that very valuable presentation. I think I've learned a lot more about this particular sector than I ever did, actually. As an analyst, we kind of look at it as a, from quite a far distance, but this is quite a good presentation. We do have a couple of questions coming in, but I think we'll just kick off with one on ESG. Now, for some of our audiences out there, ESG stands for environmental, social, and governance factors. So ESG, has been a big thing in the US, and obviously it is also a big thing in our sunny Singapore these days. So at Centurion, ESG is not just a thing that you put on your PowerPoint slide. It is also something which I guess is, part and parcel of your business model. And Centurion has also focused on the physical, mental, and social well-being of his residents. So the question is this, right? Can management share the lessons learned from managing this pandemic? And what are some of the practices or lessons like safe distancing measures, so on and so forth, that the management intends to continue going forward?
Sure. Hi, Benjamin. Thank you for the question. Firstly, I think for ESG, I think every company would like to embrace within the business model. I guess for Centurion even more currently due to pandemic, the S part, that means the social part, is being amplified. Very much many times, right? In terms of how I see the company manage the business. I would say that it's very core in Centurion's business even prior to COVID-19. Social well-being of the residents are really our top priority within our business core. So besides just, I would say, give them a roof and over the head, and also four walls, we basically provide much more than that. In fact, I would say that we are the first one who actually came to provide a lot of mental well-being events, social events, and we actually cooperate with many NGOs in Singapore to do so. One of which is HealthServe. They give a lot of free consultations and health checks. We work with Project Tulip Streets, various churches, MWC. So that is actually to add color to the migrant workers staying in Singapore. So they are basically staying. They are actually a community in I would say in Singapore. So their families are away, and therefore we feel that is a very good and important thing for us to do in order to address their I would say not only just physical but also the mental and social well-being. Now that being said, when COVID strikes, all these things actually just disappear because community seems to be a dirty word, right? I mean, in that sense, they can't gather together. All those activities that we have actually scheduled in the past has all gone to the drain. So what we have done is that we have to climb onto another model that is pretty much virtual. We have to provide a lot of other, particularly during even the lockdown when they are in the room. So we actually provide a lot of online contests, a lot online activities, cleaning unit competition to make that engagement, so that for them at least there's something to look towards. Of course, we also give them free Wi-Fi so that they can connect to their homes easily. These are all the things that we have done during this COVID lockdown, or even now, primarily because of the fact that the workers, unlike many Singaporeans, I mean, now currently it's a bit different because of the new variant. I mean, now, it has been for quite a long while since when there's a lockdown till now. The foreign workers cannot go to the community to buy their things and all. They have to, I would say, their movements are rather restricted in the sense that they go to work and then straight away they will come back to the dorm. So there are not much entertainment that in the past that they used to enjoy, going to Little India, etc. So those were the past. So when they come back to the dorm, they are also subject to a lot of those safe living measures and all. And some of the residents will look at it as that, well, it seems that, you know, it's like jail, right? I mean, some of them express this way. So we don't like that to happen. In fact, we because of that, we promote even more. We leverage on technology. We have a Myanmar app that we engage them not only for the daily needs in terms of remittance and also online delivery of items from the minimart, so that they don't need to queue, and many other things that we use the app to provide that kind of convenience where they need to book amenities, as also the scanning of QR codes going into the different floors and giving them this kind of assurance of safety when they are staying in the dorm, which in the past we don't have that particular issue. So leveraging on many other things, Facebook Live and all that, just to do the engagement and free vouchers being given to them when they are staying in the dorm. But of course, the most important thing is that for us, as we are operating a purpose-built dormitory, there are a lot of community space within the premises, so they can actually seek some entertainment within the dormitory, the gym room, the gyms and all that. But now, because of the new variant, we have actually closed it down again. We have tried very hard to actually open up progressively, maybe, you know, in April, you know, and that's what we do. So what are actually the lessons learned that, you know, throughout all these things that we are currently doing? One thing I think from COVID-19, we have learned that while we have all the safe living measures, we have all the social distancing and all that, we knew that I think to prevent COVID-19 from, or infections in the dorm, is quite relatively impossible. I mean, it's just it's a matter of time. And because this COVID-19 is actually asymptomatic, the way to detect them is difficult, and is very, I would say, we are very happy that the government has actually taken the steps in order to detect them. As long as we detect them early, we're able to contain them, and that has been what the government has been doing on doing the RRT. We call it routine testing for all foreign workers, particularly the COVID-19 naive ones. Now they are testing also the recovered workers above 270 days. So all these things help us within the management of the COVID-19 within the dormitory. But more importantly, based upon what we can, apart from just the detection, the prevention is very important too. That is where we have actually come in, based on our expertise, to put in a lot of measures. We call it segregation measures and safe living measures, to ensure that if really that there's a COVID case coming into the dormitory, the processes that we put in place and the physical segregations that we put in place will allow, or will not allow, the COVID-19 to transmit easily within the dormitory. and because of that, we are able to also contain. And if really that there are cases whereby, like for example, the Woodlands case whereby they detected COVID-19 through that. Apart from the segregation measures that we have to ensure that there's no mass transmission within the dorm, we have to respond very quickly in terms of containing the spread beyond the dormitory. So during that incident, we actually recall and retrieve all the workers, even though they are in the workplace, back to the dormitory, right? Because there's a call for that, because this is actually a new variant. So these are the things that, the corporate, as far as we are concerned, that this is actually the corporate responsibility that we do. And we believe is that this is, going forward, I think this is what we will have to do while hoping that COVID-19 will go away.
Thank you very much for that answer, Mr. Kong. I think it's quite heartening to see all the community events that you had planned prior to COVID-19. I mean, I can certainly sympathize with the workers staying in the kind of dormitories, because even at home, we're all working from home, and I've got this severe case of cabin fever. I just can't wait to get out. So I can certainly sympathize with those guys living there. Okay, the next question is from a member of the public, and this question it deals with a little bit on the finances, and the specific question is, how much of a difference in percentage is the profit margins between the temporary quick build dormitories and the purpose-built worker accommodations? So that means you got the different profit margins of the two different types of products. Is there a big difference?
Actually, there are not a very big difference. But of course, for the QBDs, if you're talking about the QBDs, technically don't own by us. We basically lease from the government, and therefore there is a rental element that we pay to the government on the monthly basis. So if you have added in that rental, obviously the margins are lower. But if you exclude that, the margins are pretty much the same compared to what we are actually running our purpose-built workers' accommodation now.
Okay, so you're just talking about the difference between the gross profit and the net profit margins. Okay, that makes sense. All right, let's move on to a different question. Okay, we have a question from a different viewer, and the question is this: who are your key competitors?
Are we talking about the student or workers?
I guess both sectors.
Okay, sure. I think in Singapore, there are actually, I think the dormitory operators are quite fragmented, I would say, but there are four, I would say, the largest dormitory operator in Singapore. This is being Avery, MES, and also probably S11,
yeah,
right?
Plus ourselves.
And plus ourselves. So there are about four big players, right? But we don't see that we are really competing head on head. Actually, it depends also where the dormitory is sited within Singapore, even though Singapore is a small country. But again, for the East, I think is a bit more lacking, and therefore competition is a bit, I would say from the East, in terms of dormitory, the number of dormitories are a bit, I would say, fewer, and therefore the competition there is lower compared to the West, right?
I guess that kind of makes sense. The West side is where traditionally the heavy industries used to be. So yeah, it kind of resides there. It kind of makes sense. So even for workers' accommodations, the three main things is location, location, location. It's just like buying a condo. Never thought of it that way. Okay, let's move on. Okay, we've got a question from a different viewer, and this is something that we chatted about just now, David. The question is also about the possibility of Centurion pursuing a REIT listing, either for both its PBWA or its PBSA businesses. So this on the back that I think previously Centurion may not have met the regulatory requirement. Not really sure about that. But going forward, is this something on the cards? And when can we look forward to this? If at all you're considering it.
I can't share with you exactly when in the process that.
Totally understand, yes.
But again, I guess it's always in our minds how in the first place we actually best use our capital, recycle capital and all. So setting up a platform in the REIT make a lot of sense, right? It's a matter of time when we get there. So it's a bit also, we have tried previously. I think that's what I think the audience actually said, but because of the regulatory requirement, we can't. But this is always, we will continue to evaluate and at the right time, we will do that exercise.
Perhaps just to clarify, I think the regulatory constraint at that time, a number of years back, was because more than 85–90% of our business at that time was worker accommodation. And therefore, it would have created what the SIAS calls a chain listing, where the mother company as well as the spun-off REIT are both holding the same business. Today, yes, we have both worker accommodation and student accommodation, but I guess it is something to consider. The situation is different today, and we are in a better position to consider such an option.
Okay, and of course, on behalf of our SIAS members, do let us know before you say that so we can buy the shares first. Obviously, I'm kidding, friends. Or straight, I'll be going to jail. Okay, next, maybe we take one last question because it's already 11 minutes past. The question is Centurion still listed on the Hong Kong exchange? And are there any significant differences between the valuation, both in the Hong Kong exchange as well as on SGX?
I wouldn't say that there's a very big valuation difference, right? Of course, the strategy of going into Hong Kong is slightly different because we wanted to open up in terms of our exposure of our name and therefore create more business, particularly on different locality. So in terms of the, I would say that at the moment, the listing of the Hong Kong listing has not really in terms of driving volumes in Hong Kong, right? But again, part of as I say that this is only part of our reasons for listing in Hong Kong.
Okay, that kind of makes sense. Yeah, so obviously different capital markets have got their own different take on the value of the same company. So that's not uncommon. So this is the last question that we have time for. We're already over time. So I would like to thank both Mr. Kong as well as David. We're very grateful for you to have spent time with us, especially answering all the different questions from the members of the public. So I'm going to hand the time now to Christine, the MC, to do the closing slides. Thank you.
Thanks to all the panelists for your active participation and inputs. So we have come to the end of today's session. It has been a pleasure to have you with us. In case you missed out any part of today's session, you can rewatch the session on our SIAS Facebook page. Do like our page and check out our website to get updates on our upcoming investor education programs and initiatives. Thank you and have a great evening ahead.
Thank you.
Thank you.
Thank you, everyone.
Thank you.
Everyone. Thank you.
Thank you. Bye-bye.
Bye.